Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're covering the qualifications for a 401k hardship withdrawal and what you need to know before requesting one. And there's a record number of Americans who are taking hardship withdrawals from their 401ks right now. So if you're considering taking one, make sure to watch to the end because you need to know these rules up front. Otherwise, you might be denied. And in one of the qualifications, you may have a good chance of being audited if you don't know the rules. And last time I checked, none of us want to get audited. So,
No.
Brian, before we get to the qualifications, let's start with how the IRS defines a hardship.
Okay. According to the IRS, a financial need may be immediate and heavy, even if it was reasonably foreseeable or voluntarily incurred by the employee. The amount you pull up must be limited to the amount necessary to satisfy that need. So if you need 10 grand, but you ask for 15, they may not qualify you and may deny your request because it was over the amount of the actual need.
All right, so now that we know the definition, let's dive into the first IRS hardship qualification, which is medical expenses that are not covered by insurance.
Yeah, this hardship here, Michelle, could cover things like surgeries, treatments, or even medications that your insurance doesn't cover.
Okay.
Very
Moving on to this.
common too. Very
Yeah,
common.
I bet. Well, I'm always amazed at how much insurance doesn't cover.
Right.
So let's move on to the second one, and that is for purchase of a principal residence. And this is the only one that has a withdrawal limit. Is that correct?
Yeah, that's correct. If you're planning to buy a home and you need money for the down payment or other related costs, like closing cost,
Mhm.
you may be able to withdraw funds from your 401k. This hardship qualification excludes mortgage payments, though.
Okay,
You have to know that.
got it.
If you're a qualified first-time home buyer and you need money for that down payment or your closing cost, you can take a hardship distribution of up to $10,000 from your 401k.
Okay, so 10,000 is the limit on that.
Yes.
And this is the one that's most likely to be audited, correct?
Yeah, that's right. It's most likely to raise red flags and get audited, which is kind of odd because honestly, at your closing, you have documents
Oh,
you
right.
sign
Yeah,
that
absolutely. You've got all the documents you need to prove it.
that makes no sense. But anyways,
Well, I'm not even going to try to figure out why the IRS does what it does. So let's move on.
next.
Post-secondary education is another reason for a hardship withdrawal. I personally don't understand this one because it doesn't really seem like, to use the IRS lingo, a dire emergency to send your nephew to college.
I don't get this one either, but here's the rule. According to the IRS, if you or a family member is pursuing higher education, such as college or vocational school, you may be able to use your 401k funds to pay for tuition, books, or any other educational expenses.
All right, moving on to number 4 on the IRS list of qualifications is taking hardship to prevent foreclosure of a principal residence or eviction.
Now, this one actually makes sense.
Yeah,
Okay. If you're at risk of losing your home because you can't afford your mortgage payments or your rent, you may be able to withdraw from your 401k to help prevent that foreclosure or that eviction. This hardship withdrawal can provide temporary financial relief and give you time to find a solution. I
yeah,
agree with this one.
absolutely, absolutely. All right, so the fifth qualification is if you need the money for funeral or burial expenses for a loved one.
The IRS says that if you experience the loss of a loved one and need financial assistance to cover funeral or burial costs, you may be allowed to withdraw from your 401k.
All right, so let's move on. The sixth and the last reason that you can qualify for a hardship withdrawal is for repairs to your principal residence due to casualty loss. So walk us through this one.
Yeah, originally this casualty loss or property damage to your principal home would have been tax deductible under Section 165 of the Internal Revenue Code.
Huh.
But from 2018 through 2025, the Tax Cuts and Jobs Act, the TCJA, declares such losses are no longer tax deductible except for in specified federal disaster areas.
Interesting.
Yeah. So if your home suffered damage from a natural disaster or any other unforeseen event, you may be able to withdraw money from your 401k as a hardship to cover the repair cost.
Hmm.
This money can help you restore your home and recover from the financial impact of that damage, whatever it may be.
Okay, listen, here's the thing. If you don't qualify for a hardship, you still can withdraw early, but
Yeah.
there are taxes and penalties that you need to be aware of. So go check out a video we're going to drop below. It's how to avoid that 30% in taxes and penalties if you're going to withdraw early.
Exactly.
All right, Brian, one last question before we wrap this up. How does someone go about applying for a hardship?
Okay, you're going to need to check with your employer or even the plan administrator because each plan may have its own set of documents specific to this process. So,
All right. Well, there you have it. Again, we're going to drop that video below on how to avoid losing 30% of your 401k money to
yes,
penalties and
watch it.
interest. Also, if you like the content of this video, hit that like button. Don't forget to subscribe. And as always, thank you so much, Brian, for this. And thanks to everyone who watched.
Thanks, everyone. Have a great day.